We all hate dead money stocks, and today we are going to see like what is worse than a 50% drawdown with the stocks that is not moving for multiple years. I'm Andy for Tokyo Alpha Mind, and in this video we are going to review 6 stocks that haven't moved in the past 5 years and that are today considered dead money stocks, and we are going to see like if they are still worth investing in. So let's get started. The first dead money stock that we are going to review today is actually the pinnacle of the dead money stock, and this is PayPal. So yes, PayPal has actually seen very high highs in 2021, but has crashed since then and has not moved. And even with a lot of good news and a lot of revamp and turnaround in their company, so the stock hasn't actually lifted off in the past few years. And so that's why actually today PayPal is called PayPal, and that even with the arrival of Alex Chris and the turnaround strategy on a focus on a more profitable growth, PayPal still has not moved past the $100 mark. And so for a lot of different investors that are seeing tremendous value actually in PayPal due to the very low valuation, this is a bit frustrating because PayPal is not really moving, and despite like all the share buyback that they are doing, despite the revamped growth strategy that they have, where they have not really moved yet. So first, a very quick disclaimer, this is not financial advice at all. There is no buy or sell recommendation in this video. This is for entertainment only. So what's going on with PayPal? So PayPal is today growing at high single digits in terms of revenue, but what's more important is how they are going to grow their EPS going forward. So they are going to have a growth in terms of EPS of more than 10%. So what we're going to see is like the growth in terms of EPS in the teens, and that's what's very interesting and very actually attractive today with PayPal. And as we've seen in another video, so PayPal is actually a very good candidate for a double in the next 5 years because of all the share buyback that they are doing. They are buying back basically almost 10% of the share outstanding every single year, with around 6 to 7 billion in terms of free cash flow every single year. So let's see a few statistics and a few valuations for PayPal. So basically PayPal is today a $65 billion company in terms of market cap, and what we are seeing is that in terms of P ratio, so in terms of the next 12 months for the P ratio, so we have a P ratio of around 13, we have a PEG ratio of around 1.2, so this is very reasonable. In terms of EV to EBITDA, so around 9, and in terms of price to free cash flow, I think this is also very attractive at around 9 also for PayPal. Basically, what you can see is that PayPal is today very cheap. I cannot say it again. So these multiples actually like they are even like lower multiples than the Chinese stock. So this shows you that there is a lot of pessimism, or at least not a lot of optimism into PayPal, which actually translates into these very low multiples. So basically today, after the euphoria we have seen so in 2021 with PayPal, and unfortunately for PayPal shareholders, like a crash in 2022, and the stock has not really moved yet. But what we are seeing in the business is actually the business, even though it's not that exciting because it is payment, so we have seen that PayPal has actually done a lot of things to continue growing and to grow more profitably. So even though that the revenue is not going to continue to grow fantastically double digits, but we are going to see an improvement definitely in the profit margin of PayPal, and we're going to see that going forward. And I think that PayPal is going to surprise a lot of different investors in the coming years. So it will definitely move from a dead money stock to a very huge gainer when people are going to realize all the improvement that are going on with PayPal. The second dead money stock that we're going to review today is, I think you guessed it, it's Alibaba. Why Alibaba? Because in 2020 and 2021, so Alibaba reached very similarly to PayPal, so the $300 mark, and until then, like it just crashed up to $62, and now it's actually struggling to go beyond the $140. And so with this price action, so that's why Alibaba is now considered like kind of a dead money stock, because the clampdown on the Chinese equity and the pessimism around China has been going on for the past 5 years, and so the stock has not really been able to actually goes back to its all-time highs and very far from that. But we still have a lot of pessimism around Chinese stocks, and it's actually anchored in a lot of investors' mind that China deserves this kind of lower multiple and lower valuation. So we have seen that with a lot of different Chinese stocks, but I think this is very true with Alibaba, despite all the tailwinds that Alibaba has, despite the stimulus we are seeing with the Chinese central bank. Still, the Chinese stock are still very undervalued, and we are continuing to see like a price action, which is actually very tough for Alibaba investors, because even though like I think a lot of new investors have bought below $100. I think for all those that have bought in the 200s, for example, when it was actually quite cheap optically, then they're still not breaking even. So that's why I think that Alibaba in the past 5 years has been dead money. But going forward, I think that you've seen my other videos, I am very bullish about Alibaba. I think that the story for Alibaba has transformed a lot, because we went from Alibaba, the e-commerce growth in China, to Alibaba, the AI leader in China and also in Southeast Asia. So we are going to see actually a re-rating in Alibaba. I'm pretty sure of that, when people are going to realize the powerhouse it is in terms of AI and how profitable they're going to continue to grow going forward, thanks to both the e-commerce but also the AI business. I think that this is going to create a lot of synergies in Alibaba business, and I think that people, they do not realize that for the moment. And in terms of Chinese equity, I think that today a lot of investors are still considering China as uninvestable. That's why all the Chinese stocks have been kind of dead money in the past 5 years. But I think that this is going to change also a little bit, especially if we see a rotation out of the US stock market, and a lot of foreign investors as well are still going to continue to be very interested into Chinese equity, and especially the main one, which is Alibaba. So in terms of valuation for Alibaba, so today Alibaba is a $265 market cap company, and what we are seeing in terms of valuation, so for the next 12 months, so we have a P ratio around 14, and in terms of EV to EBITDA, so we have a multiple around 8.1, and in terms of price to free cash flow, so even though that Alibaba has been reinvesting a lot to support the growth in terms of AI, we still have a price to free cash flow of around 13, which is actually pretty cheap, especially if we consider US hyperscalers. So we are seeing that Alibaba still at $120 is actually pretty cheap, even though it's not as cheap as what it was before, but the perspective in terms of AI have kind of changed. So I think that the story is even better for Alibaba at the moment. And I think that even though it has been a dead stock in the past 5 years, I think that in the next 5 years it's going to surprise a lot of different investors. The next dead money stock for you guys is Pfizer. So Pfizer actually has been a big winner of the COVID wave, if we can say it like this. But actually in the past 5 years, the stock, even with dividend reinvested, has been kind of a dead money stock. If you held this stock in the last 5 years, so definitely you didn't make much money. And I think that's a bit unfortunate, because actually Pfizer is actually a juggernaut in terms of pharma, and actually it is very cheap today. That's why a lot of people are kind of interested into Pfizer. But there are a lot of growth concerns in terms of pipelines for Pfizer, with a lot of different patents expiring going forward. And I think that that's why a lot of investors, they are kind of shying away from Pfizer. And so this shows that even though like the stock is still very cheap, then there is not a lot of enthusiasm around this stock. Same for PayPal, same for Alibaba, but for Pfizer, I think it's even more evident, I would say. So today, Pfizer is a 144 billion company, and in terms of valuation, so what we are seeing is that a P ratio of around 9, so very low, and in terms of EV to EBITDA around 9 also, and same for price to free cash flow. So basically Pfizer is around like like a 12 or 13 billion dollars per year free cash flow machine. In terms of dividends, so the dividend from Pfizer is around 6 to 7% today, which is actually pretty good. And I think that with the dividend reinvested, a lot of investors might actually do very well. But for that, I think we really need to see some price action from Pfizer, because in the past 5 years this has not been very actually very effective in terms of price appreciation. And so basically, like, we have to lift all the doubts in terms of growth for Pfizer, because we have seen a lot of different pharma companies getting much more actually success in the market. So with like Novo Nordisk or Eli Lilly, but even those are, they are kind of taking a beating recently. So I think that the whole conversation around healthcare stocks and pharma stocks has been a very bad actually in terms of sentiment from the market. So if we see like a kind of a turnaround in terms of sentiment, so maybe also Pfizer is going to benefit, and we're going to see a recovery in terms of price for Pfizer, which is going to actually give us actually a pretty good investment, or I would say a fair investment for Pfizer going forward. So I would not be as confident as for PayPal and as for Alibaba. The stock is very cheap, but if the stock doesn't find the growth back it had in the past years, it would be very difficult for the stock price to recover meaningfully, for the stocks not to be dead money and not to be a value trap. So I would say, like, I don't really have a firm opinions on Pfizer at the moment. It is still indeed very cheap, but there are still valid concerns regarding the patent and the pipeline that Pfizer has at the moment. Next stock on the list is Intel. So Intel has been in a lot of news recently thanks to the investment from the government and the stake taken by the administration with a 10% stake taken in Intel. So basically Intel has been dead money for like the past 5 years, but I think that this is quite deserved given the poor execution that we have seen in Intel, and also like the kind of change in strategy constantly that they had between their foundry business or their design business. And I think that Intel is actually in a pretty bad position at the moment because there is no clear turnaround plan for Intel at the moment, and they're actually entangled into some kind of political leverage that we are seeing with the government. So I think that a lot of people are seeing Intel as the US champion for actually delivering AI chips, but I think it's going to be difficult because the real technology is more on the NVIDIA and the AMD side, or even the Broadcom side, and I don't think that Intel at the moment is actually a real competitor in these industries. So maybe the government is going to actually force a lot of different companies to actually use Intel. I think that this is the only bull case that we can see at Intel, but given the poor execution from the management in the past decade, I think that we have to wait and see, because Intel has been cheap for quite some time at the moment. And even if we look at the valuation today, so actually given the fact that they are not making a lot of profit, or they're even not profitable at all, so they don't have a relevant P at the moment in terms of price to free cash flow. So the free cash flow is actually negative, so it's not very meaningful. So well, I say that Intel was cheap, but it was before. Now Intel is not even cheap at all, because this is not actually, I think, a viable business at the moment, that it is not growing. It has a lot of difficulties to be profitable, and so I think that this is a very dangerous situation for a lot of investors, because I think that people, they are seeing some kind of possible opportunities with Intel, given that it is actually pushed by the government. But the reality of the business is that this is not a business which is winning. So I think that this is very dangerous to be in this type of stocks, because we all know that what happens to businesses that are not growing, that are not winning, that are not being able to be the number one in their field. So I think that AMD and NVIDIA and Broadcom, they are going to continue to grow. They are going to provide this AI revolution with great chips and great resources. So I think that the AI infrastructure is not being reliant on Intel at the moment. I think that no one is hearing about Intel in terms of AI capex or AI infrastructure at the moment. So to be honest, I don't think it really makes sense to invest in Intel today, except if you want to play the leverage and the lobbying from the government for a lot of different companies to use Intel instead of either NVIDIA or either Taiwan Semiconductors. So I think that the only hope for Intel shareholders today for not being a dead money stock, or even worse, to not being a stock going actually to zero, is basically for the government to actually force the revolution and force the adoption of Intel standards. So the next stock that is considered dead money stock by a lot of people just looking at the charts is Verizon. So Verizon actually was actually pretty cheap a few years ago, when it actually go down to around $30. So I think there was a play there, but today the stock has recovered to $45. And if we look at the past 5 years, basically in 2020, so it was around $60, and today it's around $45. So what we are seeing actually also on the chart, and here I'm showing the total return, because I think it's very important, because Verizon is actually giving like very high dividends, and so we are seeing that even with dividend reinvested, so Verizon in the past 5 years is actually dead money stock, meaning that you have not a positive return even after 5 years, even after reinvesting dividend. So definitely that was not a great bet to bet on Verizon. I think that they have a lot of positive going forward. I think that there is a lot of development around 5G, especially in terms of replacing fibers, or actually going into territories that are not covered by optic fibers. I think there's also a play with players like ASTS, for example, meaning that satellite communication. There are some possibilities for Verizon, but today we are not seeing a lot of growth from Verizon. There's still a lot of debt on their balance sheet, so it might be actually helped by the lowering of the interest rate. I think that if the leverage, they might have actually a chance to actually bring much more free cash flow towards share buybacks. Today, so Verizon is actually pretty cheap if we look at the valuations, around 9p ratio, around 7 to EV to EBITDA, or even a price to free cash flow of around 9. So I think that Verizon is actually a fair play today. I don't think this is a very exciting play, despite their 6% or 7% dividend yield. I think that for dividend investors, it makes really sense to actually invest in Verizon, given that it has actually a decent growth profile. I don't think it's going to be a double. I don't think it has the potential like PayPal or Alibaba. I think it's a better play than Pfizer, for example, because it's much more solid and it's much more resilient in terms of recession. So I think Verizon is actually a good bet if you want a safe, I would say, stock. Today at $45, I don't think it's going to be that much of a dead money as it was in the past 5 years, but definitely going forward, I think it's going to be difficult also to have a meaningful return with Verizon. I mean meaningful by beating the market. I don't think that Verizon is going to outperform the S&P 500 coming from a $45 price. Next stock on the list is Salesforce, ticker symbol CRM. So CRM is today very polarizing because it has been a darling of the market so in the past decade, but in the past 5 years it has actually been quite dead money. So meaning that if you bought the stock 5 years ago, you have not made much return today. And so I think that Salesforce has a lot of pessimism actually around the stock, especially coming from AI. I think a lot of people are kind of forcing that AI is going to replace all the software as a service companies, so all the SaaS companies, and especially Salesforce. Well, I think that if you look at experience from the field, I don't think that anyone is going to replace Salesforce very soon. I think that no one is going to rebuild a CRM with vibe coding. Definitely not. I think that this is something that, well, if you think that this is possible at the moment, I think that you should maybe deep dive a little bit into what Salesforce is doing and how companies are using CRM, or they are using their CRM, meaning their customer relationship management tool, because they are not going to build that themselves. Same as with their ERP, companies are not going to rebuild their ERP by themselves. So I think that there's a lot of maybe too much pessimism around Salesforce, and today the stock is actually pretty cheap. So if we look at the different metrics, so in terms of P ratios around 21, in terms of EV to EBITDA 13, in terms of price to free cash flow around 16. So I think that, well, I said cheap, but I think this is pretty fair valuation today for Salesforce on the next 12 months basis. One thing which is concerning is actually the deceleration of the growth. So today we are in the mid single digit growth for Salesforce in terms of revenue. For Salesforce to actually become a juggernaut once again, I think they are going to have to focus on profitability, same as what PayPal is doing, same as what a lot of different companies are doing. And I think that's true for a lot of software companies. They're going to be, or they're going to have to be focused on getting much leaner, much more profitable, and going to be into war mode. I think that Mark Benioff should actually stop buying all these companies. I think that this is really destroying shareholders' value, and focus more on being leaner in terms of headcount, I think, at first, and in terms of company altogether. So I think that what's going to drive the price from Salesforce is going to be the profitability of the business. If it doesn't improve, the price is going to actually stay very stagnant. But if we are seeing a meta type improvement in terms of businesses, in terms of profitability, definitely Salesforce is going to be a huge contender to be a double in the next 5 years. So that was 6 stocks that are considered dead money in the past 5 years, and I think for legitimate reason, because their stock have not really moved in the past 5 years. But looking forward, and I think that's your job as an investor, you have to look forward, you have to predict the future, and I think that some of these stocks I still have a lot of potential in them. I'm particularly thinking about PayPal and Alibaba. I think some of them have actually some kind of potential issue that they have to solve, like Salesforce in terms of profitability, and I think also Pfizer in terms of growth. And we have also like very fair value, and I think that I'm not going to be a very exciting play with Verizon. And finally Intel, which is actually kind of a wild card, because I don't think that Intel can actually come up as a big winner today, but the fact that the government is investing into Intel, is taking a 10% stake, there is actually a lot of chance that Intel is going to be pushed towards a lot of different companies. Well, I think that this is not financial advice. This is this is the disclaimer. You should do your own due diligence. You should deep dive into these companies if you're interested. And also, like, this is not a recommendation to buy or sell these stocks. But this is my analysis. And if you're interested in other analysis like this one, so please check my other videos. Please put some comments and what you consider other very interesting than money stocks. Please subscribe to the channel, and I'll see you in another one. Bye.